Hello everyone, welcome to day 4, and now we'll finally dive into the market. And the topic of today, I'm going to keep it short, is going to be market participants. This is not a necessity, but I think it's a very good way of building the basis of your knowledge in trading and to understand what are the charts and what is your role in that whole ecosystem. But first of all, I'm going to go through an overview of understanding the whole financial market, right? So let's say that's you and how the institutional traders, and the institutional people call retail traders, they call them dumb money, right? So let's say that this is us right now, right? And we are here, right? And this is basically educators. So the educators are going to be the people, the influencers, the people that tell you they know what trading is, and the people that want to teach other people, right? That's why I do it in a very different way, because you're going to understand who are the good educators, who are the bad educators, and how can you hedge the risk when you go out there and you try to learn trading. And this is a very, very important thing to understand and to know, because this is exactly how you're going to limit your downside by being able to separate what is noise and what is valuable information for you as a trader. So, educators that are going to be directly linked to you, okay, they're going to come to you and tell you, hey, okay, we have I don't know, I'm going to teach you, and we have that broker, and this broker is good, and this way of trading is good, blah blah blah, etc etc, and you're gonna basically follow them throughout your journey, like we all began. I began like this, my friends began like this, probably any person interested in trading that will Google trading, that will look at YouTube videos, will go through this process. Now, my mission is to avoid people to go towards the wrong path and spend years and years before actually discovering that this is not the right path, and then adjusting if they didn't quit before. So, understanding that between you and your educators there is some kind of conflict of interest, then you can understand how you can hedge that risk. If your educators allows a conflict of interest between you and him, so between him giving you a service and you being the client, that means that's a red flag. Like, there's no other way around. That's a red flag. And I'm going to tell you why. The simple reason is that, so you got brokers here, yeah? Brokers, dealers. So these are the people that allow you to trade. So it's a necessary evil, anyways. With brokers, what makes you lose money makes them make money. But it's a necessary evil because there's no other way around, right? So, okay, let me give you an example. If you take a trade and it hits your stop loss and you lose money, the money didn't just disappear in the air. It went somewhere, it went to the broker. Okay? So there is some kind of conflict of interest. The but the broker never loses. That's the funny thing. So when you take a trade, you pay a spread, right? When you take a trade, you pay a spread, and then you have other type of fees. Let's not go into the details. So even though you're winning a trade, for example, the broker still earns money. Now, when you lose a trade, the broker earns the same money that if you won the trade, plus the loss that you made. Now, what's funny with this is that brokers and educators, so I'm not even going to do it like this, I'm going to do it like that. So, brokers and educators work together. I don't know if I can have a dub. Yeah, I can. So, brokers and educators work together, right? So, your money will go to the educator and the broker. So you're going to put money in the broker, right? You will trust the educator that is giving you a certain service and teaching you trading. Now, what's going to happen is that between brokers and educators, you have something called, it's an agreement, it's called IB agreement. Introducing broker agreement. So this will be the agreement that both these guys will sign to agree that whatever you um, whatever you lose or whatever you make to the broker, the educator and the broker will make 50-50, or there's some kind of percentages in revenue or in spread that will um, that will make the educator richer and the broker richer, right? So if you're profitable, that's okay, they still make money. If you lose, they make more money. Now, the reason why this is important to know is because a lot of educators within that market have a lot of different type of offers and have different type of business plan, and they educate people differently. For example, the way I do it would be to avoid talking about any broker, to avoid talking about any prop firm, and not being affiliated to anything like that, to not create conflict of interest between me and my client. So my client pays me, I consult, I coach him, I give him all that person needs to reach the goal that they want with the minimum downside possible and the maximum upside possible. So there's no conflict of interest. The more they win, the more I win, because they're gonna stick with me, right? But when you have an educator that is affiliated to a broker, and when you lose, for example, they make more money than if you were winning. So what's that gonna make? What's that gonna make? So if the agreement is about revenue share, and revenue share, let's say it is when you lose money and the broker makes that money, the broker wins the money and share the money you lost with the educator. That's revenue share. So whatever the revenue is made by the broker, that revenue, a percentage goes to the broker and a percentage goes to the educator. And then you have spreads. So spreads, for example, is, let's say you take a trade and you pay an 8 pip spread. So some percentage of that spread will go to the educator. So there are two things. One way, the more you lose money, the more they make money. And in the other side, if it's about spread and not about revenue share, the more you place trades in the market with the highest volume possible, the more they make money. So the educator will be incentivized to push you to trade more with higher volume, and some educators will push you to lose, which is very bad because that creates a conflict of interest. They cannot come in good faith, and they cannot come to you and push you to win and push you to win, because that will make them earn less money. So how to erase that conflict of interest? Basically, not sharing the earnings of the broker. That's as simple as this. So you come as an educator like me, or let's say you want to learn and you open YouTube and the educator's offer is about a broker or is about affiliating. For me, that would be a red flag. So I rewind, I pull back, and I think, as a person who wants to learn, hey, what is the offer of this person? Is this person legit? And there will be hints and signs that this person is legit when there's no conflict of interest. Meaning, if you win and the educators win and you both have an objective that is um, growing with each other, meaning if you win they don't lose, they win more, or if they win you win, that there's no conflict of interest, you can trust, because they will push you to win so they can win more as well. Okay. However, if there's some kind of conflict of interest of when they win you lose, or when you win they lose, then that's a red flag. You don't want to be there. So let's move on. So that is a very important aspect because this is your introduction to the trading world. And if you miss that point, you might be disgusted of it, and you don't want to be disgusted, right? You want to love trading and you want to get into trading in the safest way possible by limiting the downside, and this is why I'm here. So, what's next? Next here, so basically brokers borrow money or borrow asset from investment banks, right? So they will go to the investment bank and they will say, hey, we want to borrow this because we want to allow people to trade through our platform, and this is why they have a spread. So if they tell you or they allow you to trade Euro USD, you pay the spread, and then that's what they win from whatever you're trading, and a bit more from what we explained. What's next? Then you have other things. Okay, what you're gonna have is that you're gonna have here hedge funds, and you're gonna have here pension funds. Okay, the only difference, they both institutions are trading institutions and investment institutions. So they deal with investments and money, but the difference is their way of trading. So they trade differently in other ways. Let's not go into the details. That's all fine, because the purpose of this is to understand who are participating within that market, right? So you have the investment banks that are directly connected to the broker. Now the hedge funds and the pension funds also use um, the broker to trade. However, these guys don't have the same contract with the broker or the dealers that you have with the broker and the educators. Okay, they have another type of agreement that allows them to completely erase the conflict of interest. So here I'm gonna put this like this: X, no conflict of interest here through contract, right? Just gonna reduce that so we can put it here and know it's just a reference, right? So here there's no conflict of interest with the brokers, the dealers, and the funds, okay? However, you do have a conflict of interest because you don't have power over the broker. Pension and hedge funds have power over the broker. And then the last piece are the exchanges. So here, I'm gonna put in big because there are probably the most important players in the game, and these guys will go here, right? So you recap, and just FYI, exchanges are monopoly duopoly, right? So there are not only the big boys, there are the boss of the game, right? So, as a recap, what you have in that economy, in that trading industry, in that finance industry, you have the exchanges that will give money to investment banks, that will give money to brokers and dealers, and that will be working with hedge funds, pension funds, etc. And hedge fund and pension funds will have a conflict that a contract that erases the conflict of interest with brokers, so they can use them, deal with them. So basically these people will be more like negotiating prices, negotiating spreads, because they are using billions and billions of dollars of trading every single day, and they need good prices, and they have some kind of power over the brokers, right? Now on the other side, all of this is the institutional side, and I'm going to separate it with a line from here, let's say from here to here, right? I'm gonna separate this with a sign in the middle of the broker, because the broker are playing both in the retail and in institutional side. And I'm gonna do it like that. Yeah, that works. Great. So you have all of this. That's institutional side, and then you move to the dumb money side. So this is the smart money, this is the dumb money, and how brokers. So think about it. If you're a broker, how would you make more money without spending money on marketing? You would basically propose an agreement to these educators, these influencers, saying, hey, if you bring me more people, what I'm gonna do, I'm not gonna pay you upfront, but as much people as you bring me, the more I'm gonna give you a percentage of what I win from the people you brought to me. And these people will invest in marketing. And then they will tell you, hey, come to me, here's a good broker, they will make money, etc., etc. Okay? So now you know about that whole complete industry. So before going to the charts and seeing, visualizing what I'm talking about, let's just recap who is making the price move, right? So there's a lot of participants in the market, as we saw, and everybody is kind of making the price move. But who are the big players? So you're gonna have governments. If we're talking about any type of stock, they're less directly um, impacted by the policies, but the most is going to be forex is going to be impacted by the policies directly. So you're going to have governments and monetary policies. You're going to have institutions, trading institutions, so basically trading and investing, right? And then you're going to have people who actually need the product, who need the product. So basically, let's say you're trading gold, people that are using that product, if the of gold, so basically institutions that buy gold, that sell gold, people, investors, etc., etc., all these people will make the price move depending on the demand of the market or the offer, the supply of that market. And then you're gonna have retail traders that are just us trying to make money, a profit out of the market's price movements. So that's a bit of a simplification. I totally I'm totally fine with it because you don't need to go into the very deep details, and we are still at the beginning, so we still have a lot of information that's gonna come. I'm gonna talk about a lot of things during this whole boot camp, and I think for now this is cool to understand. What I can add is basically in these institutions, you're gonna have market makers, you're gonna have algorithmic robot trading, right? Including HFT, high frequency trading, which changed the game. You're gonna have dealers depending on spreads, swap fees, etc., etc. And you're gonna have other type of um, players, and I include big money, so big investors in that game. Okay, and retail traders are basically going to be the small money. Okay, great. So there you go, you have a more detailed list of who are the players, right? Now if I go to the chart and we talk about the chart, I'm just going to delete this, and we talk about the charts, you don't need to exactly know who is making the price move at the price movement time, at time t, and trying to be like super precise. No, you don't need all of that. That would be noise basically, because it wouldn't serve you that much. But because now you understand who are the players, we're going to talk tomorrow about how to read the economic calendar and understand the impact of releases in the economic calendar with the price movements that impact within the market. And when you're going to link the market participants with whatever is happening in the economy when new numbers are released in the economic calendar, and then you'll see the price moving up or down, it's gonna make sense in your head. You're gonna be able to understand, oh, now I see a bit better why the price is moving that way, why the price is moving the other way, why the price is not moving, it's just choppy, and you're gonna be able to build a forward-looking view of the price movement and expecting the price to go up, expecting the price to go down, and understanding how you can hedge the risk from whatever the price will do, right? So we'll stop here. I'll see you tomorrow and we'll dive into the economic calendar. See you then.